Hey everybody, and welcome back to Investing with Wesley. What if I told you that currently where we're at right now as far as investing and interest rates go, it actually pays you to take on debt? Well, in this video I explained to you exactly how that's currently working right now, so let's get into it. Okay, so like I said, it pays you right now to take on debt. Now, most people understand debt as you borrow money and have to pay that money back plus some interest. But the interest that they focus on is the nominal interest rate. And currently, if you look at the nominal interest rates of things, you can either go to a bank or the Federal Reserve's website. No matter where you look, you're going to see positive interest rates, meaning you're going to owe more than you borrow. But if people started focusing on real interest rates, that actually turns the tide on how people look at borrowing money. As an example, real interest rates right now are at about -3% and no one's talking about it. But before we get into that, let me explain to you the difference between a real interest rate and the nominal interest rate. Now, the nominal interest rate is the interest that the bank says you're going to have to pay. The interest that the Federal Reserve says banks are going to have to pay. The nominal rate is the number you see on the website or on the application. It is the interest that they are telling you to pay. That is really easy to understand. But the real interest rate is that nominal rate minus expected inflation. So as an example, let's talk mortgages. Currently, you can get a mortgage for about 2.5% to 3% in interest. Now again, that's the nominal interest rate. Subtract inflation, which on average is 2 or 3% per year. So let's just take 3% for your mortgage minus 3% for expected inflation. Both of those cancel out and your real interest you're paying on that house is 0%. But again, that example is using averages of inflation and the average mortgage that you can get right now. Let's use some real numbers. Some real numbers is that the mortgage or interest that I owe on this house is 2.5%. Now again, nominal interest, that one's easy to find. But what is inflation? Well, right now, inflation is at about 5.5%. And you find that by going on to the Consumer Price Index, which tracks the increase and decrease in consumer prices, which translates to the amount of inflation we see in the market right now. Because remember, inflation is the decrease that the dollar has in value or the increase in prices of everything else around us. So if all products are going up 5.5% around us, then inflation is at 5.5% because it takes 5.5% more dollars to afford that same item. So the interest rate I owe on this house is 2.5%, whereas based on the CPI, the inflation is currently 5.5%. Now, 2.5% minus 5.5% is -3%, meaning just by holding this mortgage for 30 years, I'm actually profiting in the long run 3%. So let's break that thought down. Sure, I'm saving myself 3%, or I'm profiting 3%. I still owe the bank money and I'm still paying them a positive interest rate. So really, how does that whole thing work? Well, yes, I do owe a positive interest rate to the bank, but because inflation is putting more dollars into the system and more money into my pocket, those two cancel out. And they cancel out so much that there is currently more inflation than there is interest owed on my house. So in the long run, I am profiting 3%. And just to help you understand it a little more, I currently have a loan on this house for $240,000. Like I said, the interest rate is 2.5%, but the real interest rate is -3%. So instead of paying it off early or paying it off in full and basically paying cash for this house, just by holding it the full 30-year term, I'm saving 3%, meaning that by the time the loan is paid off, I'll have an additional $7,200 that I basically profited. Just by carrying this loan out long term, I'm making money. Now, if you're a little confused on how this actually works, believe me, I totally get it, because negative interest rates are something that the United States have never seen. So because my YouTube analytics say most of my viewers are in the United States, they don't really know exactly how negative interest rates work and how they could use it to their advantage. Now, you're probably confused at exactly how negative interest rates affect you, how I'm profiting $7,200, and really, let's just take a pause on that thought for a moment. because all these numbers sound well and good, but they only go into effect if you actually experience the positive effect of inflation. As an example, I still have to pay that positive interest rate to the bank no matter what. That is what the contract says I am supposed to pay. And the real interest rate only kicks in and gives me a negative rate if I experience the effects of inflation, meaning if more of the dollars being created and more of the dollars in the system actually come to me. Inflation could skyrocket all around us, but if the company you work for doesn't give you a raise to keep up with the pace of inflation, then you're actually losing even more money. And the only reason I bring this up to you is because I don't want you to get fooled into taking out debt for yourself and then thinking you won't have to pay the full amount back because of something I've said. The reality is not every job out there will give you raises that keep pace with inflation, and not everyone will qualify for a 2.5% mortgage or even a 3.5% mortgage. The benefits of taking on debt during really low interest rates and also pretty high inflation rates is that you actually save yourself monetary value by putting your debt or by putting your money into this asset or this debt instrument, as opposed to just holding onto that money in cash. Now you might be thinking to yourself, why would the government want to give us negative interest rates instead of just finding a way to lower the price of everything by the same percent? I don't need a loan for $240,000. I can just take that same loan, just minus the 3% off the top, and have the same zero or positive interest rate. Well, the theory behind it is the psychology of investing, or the psychology of buying things. Well, first off, the government doesn't control the prices of things. The prices of things are controlled by the buyers and sellers and people willing to pay whatever price is labeled. And of course, it's just ludicrous to think that there's going to be a national press conference telling everyone to slash their prices by 3%. It just doesn't work that way. So in a sense, when the government messes with interest rates to give us a negative real interest rate, they're in a sense telling us that they're going to pay us money to take on debt. And the whole purpose behind this is to stop people from hoarding cash. Because when you hoard cash, it is subject to inflation, meaning just cash sitting in a vault gains no value but loses value every time more money is printed. They want you to spend that money. They want you to take on debt by buying assets or research and development for whatever business you're in, or in this case, it is buying real estate. When people are lucky enough to get a real interest rate of 0 or even a real interest rate of a negative percent, the government and their money printer are basically paying you to take on that debt and carry it long term. So no, the government can't just make everyone lower all the prices of everything by a couple percent, but they can offer tips and incentives to make it worth your while to, in a sense, borrow money long term. And long term, you'll save as much money as if they did lower all the prices by that same percent. So carrying my mortgage long term basically gave me a $7,200 check. So by not hoarding cash or not committing extra payments to my mortgage, but just by using my money as leverage and then borrowing for 30 years and holding on to that note, it means I've profited long term $7,200. I understand that negative interest rates and negative real interest rates are a very confusing topic for a lot of people, and I hope I did a good enough job explaining it to you so that you have a better understanding of what it is. I have a dedicated Facebook and Instagram account. I don't post there too often, but if you ever had a question, comment, wanted something addressed, or even had a recommendation for a video that you would like me to talk about, feel free to message me there because going through all the comment feeds can be a little confusing. Either way though, the choice is yours, and I'll see you in the next episode.